This episode of the Old Dawg's REI Network is brought to you by Mino Studio. Mino Studio is a pre- and post-production facility for all of your audio needs. Mino Studio's founder is an accredited audio engineer with top 40 and indie album credits. With over 30 years of music industry experience, Mino Studio can take your podcast from idea to reality. Contact Mino Studio at minostudio777@gmail.com for more information. That's minostudio777@gmail.com.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dawg's REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dawg's REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Well, hello, old dogs. Wow, this is great. We're so excited to have you listening to this show. Before we start with the interview, I just wanted to say a couple of things. First, thank you. Thank you for listening to us. Thank you for taking the time. We know you're busy and taking the time to listen to our show and participate. We are so grateful for. I want to tell you, too, that we'll be releasing our podcast on a regular basis on Monday mornings, unless, let's say, there's a holiday. We still may release it on Monday, but generally Monday mornings. You should be able to wake up in the morning and be able to download the podcast for that week. Also wanted to just invite you to visit our website, olddawgsreinetwork.com. Of course, dog spelled D-A-W-G-S. Anytime you want to come by. There's a blog there. We have a lot of articles and information that would be of use for you in looking into real estate investing. I have a list of my top real estate books that are a great place to get started on the education process, and a lot of other resources that you'll be able to download or read or have access to, including our podcasts, which will be available soon on our website. I also want to announce, too, that we're going to be doing a separate podcast that will come out on Fridays. We call it Fun Fact Fridays. And Fun Fact Fridays will be special broadcasts that will convey important real estate investing messages addressing key terms, concepts, and strategies pertinent to your real estate investing success. Subjects like, what is cap rate and why is it important? Or 5 tips for getting bank funding faster. These brief 5 to 10 minute broadcasts will provide a condensed, easy to understand, bite-sized picture of things you need to know to grow your real estate investments and or business. So be watching. You're on, you can't watch here, we're on a broadcast, but listen and check into our broadcast to see those and download them. Hopefully we'll have a whole library eventually of some key information that will be helpful for you that I'll be presenting again on Fridays only. So that's it. Again, thank you so much for following the show, for downloading and listening. Gosh, we've already had amazing response. Many of you have gone to iTunes and subscribed to the podcast, downloaded the episodes. rated them, and we've had almost 100% response of 5-star ratings, as well as some great reviews that you have written. We thank you for that, and that will help us to also increase our visibility as we try to reach out to more people that have a need and interest in real estate investing. So we thank you for that, and just invite you to hang out with us and continue to be a part of the network. Thank you, and God bless. Well, I'd like to welcome our guest for today, Jonathan Twombly. Jonathan is a graduate of Harvard College and Columbia Law School. Since 2013, he has run Two Bridges Asset Management, LLC, a multifamily investment platform based in Brooklyn, New York, focusing on long-term buy and hold acquisitions in the southeastern United States. Two Bridges currently operates more than 400 apartments in the Carolinas. Before forming Two Bridges, Jonathan was a partner in the multifamily investment firm TRB Investment Group, LLC. Prior to entering real estate, Jonathan practiced commercial and real estate litigation for more than 10 years at large law firms in New York, Boston, and London. He lives in Brooklyn, New York with his wife and 2 children. You may follow him at his blog, The Mortar Real Estate Blog, or at his website, Two Bridges, twobridgesmgmt.com. Well, welcome, Jonathan.
Great to be on the show. Thank you for having me. So my background in real estate, as you mentioned in the intro, I came to it a bit circuitously. I had not really ever thought I would find myself in the position of running a real estate investment firm. I had practiced law for about 12 years on and off. I tried to get out of it a couple of times and done different things. But as what turned out to be the end of my law career, I was working for a big firm. I really wasn't happy with what I was doing. And I actually had a lot of downtime because once the recession hit, a lot of the work really kind of dried up. I was already not terribly happy being a lawyer in a big firm, but now having no work to do on top of it really was driving me nuts. And I actually would sit around a lot and basically taught myself how to underwrite properties. In my spare time as a lawyer, I was on the net all the time looking at 3plexes and 4plexes, that kind of stuff. The stuff that I could find online, and like Trulia, I would be underwriting those deals and imagining myself owning them and escaping from what I was doing and trying to replace my income somehow. That was how I first started thinking that this is something that I might want to get into. Although, as I said, I never thought I would be here where I am now. I envisioned it as something I would do on the side as a way to give myself some additional income and maybe provide myself with some kind of escape plan at some point.
Now, it's kind of interesting that, with your background, I mean, you could have gone a lot of places and you could have done a lot of things, whether it's business or in the corporate side of things. Now, were you practicing any real estate law at the time, or is this just new to you?
Yeah, no, it was completely new to me. I was doing some real estate related litigation at my last job. I spent a lot of time representing hotel owners who were in disputes with hotel management companies. So we did a lot of management contract litigation and fiduciary duty litigation. So I was exposed somewhat to the structure of complicated real estate deals. But I had never seen it on the deal side. There's a lot of lawyers who go into real estate, but probably 99% of them were real estate lawyers who were working on deals for many years and thought, hey, I'd really rather be on the ownership side of things. But for me, I was tangential kind of connection to real estate law. But what happened, similarly maybe to some of those other folks who saw the upside of being on the ownership side as opposed to the legal side, I started at some point in my legal career feeling like I was really tired of being a service provider. And even though obviously lawyers are pretty well compensated, I didn't get a lot of psychological reward from my job. So I started feeling more and more like I really wanted to be in more of control of my life. I didn't want to be trading hours for money. I felt like I was just sort of selling my life bit by bit, billable hour by billable hour as a lawyer, and I really wanted to figure out some way of not just providing for income that wasn't tied to time, but also wanting to be in the position of building something being an owner and not just providing a service for somebody.
Now, focus on real estate investing. To select that, did you have sort of a light bulb moment, a time where you just, boom, you just said, this is it. This is really what I want to do and where I can really see my talents and my interest going?
Real estate was something that was always kind of in the background for me. I spent a lot of time as a kid looking at buildings because my dad taught architectural history. So he would drag me around to all these buildings all over the place. So I was always sort of surrounded by buildings. And as a very young kid, I remember I used to look at the New York Times Sunday magazine, and they had all these real estate listings in the back. And I would just look at those listings and fantasize about owning those gorgeous houses in the back. But I never really thought about real estate as a way to make money or as a career till much, much later. And at some point, so sort of backtracking a little bit, before the financial crisis, I had already been feeling very strongly that I wanted to move into something else other than law. But I wasn't really sure exactly what I wanted to do. I sort of dabbled a little bit in the idea of going into management consulting. But I had a very close friend who was a very successful equities investor who said to me, look, you've got the right temperament and the right outlook to be a successful investor. You should look into that. And I started looking into trying to move into equities investing or into finance somehow. And what I was running into was, at the time, I was already in my mid-30s, and I was a career changer, and it's just a very difficult thing to pull off. And then the financial crisis hit, and suddenly, not only was I faced with the whole career changer issue, but now there were, thousands of highly qualified people who were out on the street looking for jobs who had years and years of experience, and there just really wasn't any way I was going to be able to compete with them. So I started thinking about, well, what else could I do? And that's when I started thinking that, hey, maybe real estate is something I could do. Checked a lot of the same boxes for me as, maybe being a stock picker, but it was also something that I sort of, as I said, had that kind of background underlying interest in for my whole life.
Right. And you could have been an investor and continued practicing law, but looking at it as a full-time gig is a pretty large commitment, and just gearing yourself for that is quite a move.
Yeah, I mean, that was something that wasn't planned. I started looking at properties from my desk at the office when I had nothing to do and trying to think about, gosh, how could I possibly ever buy enough of these 3 and 4 unit buildings to replace my income? It looked like a pretty daunting task. And as I was thinking about those things, the financial crisis, proceeded, and at some point it became pretty clear to me that my job was not going to last forever. They were paying me a lot of money and I wasn't doing anything, and they kept on expecting the work to come in and it wasn't coming in. And I could see that things were probably going to be winding down. So I started doing a lot of networking. And at that point, I was thinking, well, what is it that I really want to do next? I really settled on real estate in some form. I thought, probably, given where I was coming from at a big law firm, I just assumed that I was going to try to find a job at some kind of institution and go to work for another big company. So I was running around trying to network with everybody that I could who was in that space that I met. And I was getting a lot of the same kind of negative feedback I got when I was looking into becoming an equities investor, which was like, hey, at your age, with your background, it's going to be very, very difficult. And there's a lot of people right now looking for work in that space who have much more experience than you do. So I really wasn't sure exactly how I was going to break in. And then a couple of sort of fortuitous events happened that pushed me in the direction that I ultimately went in. But one of them was I sat down for coffee with an older, very experienced real estate broker, commercial broker in the city here in New York. And, he said to me, Jonathan, I'm just going to give it to you straight. With your background and your age, there's no way you're ever going to get a job in institutional real estate in this city.
Oh,
So
gee.
just give up. Basically, it was like, good luck, buddy. Give up. I want to save you a lot of trouble. But he said, look, the only way I can foresee you breaking into this business is if somebody takes a liking to you and says, hey, why don't you become my partner? I sort of filed that away in the back of my head. And a few weeks later, somebody that I had met a couple of times during my networking approached me and said, hey, look, Jonathan, I'm starting a real estate investment firm. How would you like to be my partner?
Oh, my goodness.
I thought, okay, so my ears perked up. I wasn't really sure that this was something that I wanted to do. I didn't know, I wasn't quite sure I wanted to be involved in a startup. This was somebody I'd only met a couple of times. I didn't know if I was ready to jump into business with her. So what I started doing is talking to my friends about whether they thought this was a good idea or not. I went to that friend of mine who initially put the bug in my ear about becoming an investor and said, what do you think about this? And he said, let me meet her and talk to her, and I'll give you an idea. It just so happened that I was going over to Japan to visit my wife's family. My wife is from Japan, and met with an old friend over there, said the same thing to him. Hey, I got this offer, but I'm not really sure what I want to do. And he said, well, look, I'll fly to New York and talk to this person. So what happened was they both wound up meeting her. They both liked her. They both thought she was, smart and knew what she was doing. And they both said, hey, if you do this, I'll give you money to invest. So now I had,
Wow.
The offer of a partnership and the offer of money. And I figured at that point, maybe I just ought to do this. And the other thing that went into the decision was I actually had been let go from my job. I was on a severance period when all this happened and was trying to figure out what to do next. So I thought, I've got some money saved up. Why not? Why not take a chance on this? And that was how I first broke into the business. And that was what became TRB Investment Group, which is, the first partnership that I was involved in.
Wow. Now, was she looking for funding when she met you for the investment firm?
Yeah. So she had told me, not at that time, but at a later date when we were talking about things, she said, the reason that I wanted to partner up with you is because I just felt that you had the ability to raise money. I have to say that raising money has not been my strong suit. I was very fortunate. I'm not temperamentally the kind of guy who loves running out there and raising money. I have some, ability to do it, but it's not something I would have ever considered to be my strong suit. But that was what she saw in me. I guess she recognized that I had some, good connections, a good network. So at least I had a good start on that. And then she was right, as it turned out, since right off the bat, I was able to raise a bunch of money without even really trying to.
So, really? God, that's great.
Yeah.
Now, in getting involved with her, did she already have certain properties? Were you also looking at property acquisition? Were you trying to find properties to invest in, or what were your roles?
Yeah, so her background was that she and her husband already owned a pretty substantial portfolio of property, all multifamily stuff. It was in East Texas and Louisiana. So she wanted to take this and professionalize it. Her husband wasn't really interested in making a business out of it, but she wanted to make a business out of it. So they just decided between them that she would go and do it on her own. And that was the point where she was looking for partners to join her.
Gotcha. Okay. Were any of her properties syndicated, or did they just handle them themselves out of their own personal finances?
They had some partners in those deals, but they weren't syndicated deals. They were just her husband and his partner and my then partner to some extent.
Joint ventures, or
yeah, I don't really know what the structure was, but it wasn't.
Okay.
It wasn't a passive, syndication type arrangement. My understanding was that her husband and his partner were both involved in the day-to-day management, and they had their own management company, in-house that they used to manage the properties. So they weren't syndication deals. But what she wanted to do was syndication. She'd learned how to do syndications from, I believe, Dave Lindahl, and she wanted to make a business out of that. And that was when we connected.
Okay. And it wouldn't have included her properties, her personal properties? You're going to start from scratch for the most part?
Oh, yeah. Yeah,
Okay.
We were starting from zero.
Okay. Gotcha. So how long did that relationship last? I assume she's part of your current firm. Is that correct?
Yeah, so that lasted about 18 months.
Mm-hmm.
We started looking for deals in areas that she was familiar with, and we had a couple of deals under contract in Louisiana, we actually wound up losing both of those deals. One, because the lender dropped out at really the very last moment. And the second deal we terminated. I think we got a little bit panicky after the first experience. We were actually trying to buy two deals at the same time from the same seller. And after the bank terminated the first one, I think we got a little panicky and terminated the second one when we found something we didn't like in due diligence, which frankly, if I'd found that now, would not have bothered me at all. Mm-hmm. But at the time, we were relatively inexperienced, and I think we just got a little bit skittish from the experience of the first deal.
If you don't mind me asking, why did the bank terminate, or what reasons did they give?
Well, the reasons that the bank gave were really kind of outlandish. This was back in 2012, and the lending environment wasn't what it's been like in the last few years. The banks were still feeling really skittish about things, and I think looking for reasons not to do deals. So they came back to us. They went deep into the process. They went all the way to sending their junior underwriting guy to the property to check it out. You know, that's usually a pretty perfunctory step at the end of a deal. Mm-hmm. But that their underwriter came back, I guess based on his report, they decided not to do the deal. But the reasons they cited to us were things like, you know, the breezeways were dirty, and they found seriously, I'm not kidding you. The breezeways are dirty. They one of the vacant units had a broken window with a golf ball that had come through from the golf course next door. I mean, it was really crazy stuff, and you know, could really only lead to the conclusion that they had just decided for whatever reason not to do the deal, mm-hmm. and were looking for pretexts to get out. Wow. So it was quite devastating. I mean, we were out a lot of money out of pocket, you know, a lot of time that we'd put into it. You know, we were both, you know, financing the deal ourselves. Once we syndicated it, we would have had the investor money in the deal, but we had fronted all the costs up front, not to mention self-financing my life out of savings while we were doing this. So it was quite a devastating blow to have the bank back out at the very last minute, and then to kind of, through our own skittishness, back out of the second deal as well.
Did you lose earnest money in that process?
No. Fortunately, we had good contingencies in both contracts. Still, you know, back in 2012, you could still get a financing contingency, mm-hmm. because it was much more of a buyer's market. And so we had a financing contingency in the first deal, actually in both deals. So we were able to get the earnest money back because of the financing contingency. And then the second deal we terminated before the end of the inspection period, which gave us the right to get the deposit back. But we still had all of the, you know, legal fees and lender fees and survey and title and all of these other expenses that we had to pay for out of pocket.
Wow. So moving sort of fast forward here, you obviously decided at a certain point to set up your own company. And in that process, were there things that you learned that you said, you know, when I set this up, this is how we're going to approach it, or how I want to approach it?
Yeah, well, I mean, that's a good question. I don't feel particularly what we did in the first go-round with my first partner was mistaken. I mean, we definitely had a lack of experience, and so I learned a lot from what we went through. But, you know, there wasn't anything in those deals that today still don't think that they were too risky, or that there was anything wrong with the profile of the deals that led the banks to act the way that they did. But what I did change when I set up my own business was I changed the fee structure facing the investors. We had had some pushback from the investors about the amount of the cut as sponsors that we wanted to take. And that was a bit of a point of dissension between me and my old partner. Mm-hmm. You know, she had gone through the course with Dave Lindahl, and I guess there had been some discussion in that course about what the appropriate split was. But I got pushback from, you know, my investors about the costliness of those fees. And when I set up my own business, I thought, I'll do things differently. The typical syndication model that a lot of people learn is what I call the 10 dentists syndication model, where you get, 10 dentists who are each able to write a check for $50,000. And that means that they don't really have the ability to go and do a big apartment deal by themselves. So they don't have a lot of leverage in terms of the fees. And they're sophisticated people in terms of running their own practices, but they're not necessarily so sophisticated in terms of investing in deals. So if you say to them, hey, look, I'm giving you an 8% preferred return, they say, woohoo, well, here's my check. And they're not so concerned about how much of a cut you're taking yourself. When you're dealing with people who can write you 7-figure checks, it's a very different conversation, and they look at things quite differently. And they want to know why your fees are so high. So when I did my own business, I realized I really had to change the structure in terms of what we charge for fees.
So what's a typical model? I know it could change from deal to deal, but do you take a management fee? Do you take fees up front?
So we do take some fees. It's more in terms of like how much of the upside that we participate in. We take an acquisition fee, which is not outrageous. And we do 3% of the equity capital that we raise. We do an annual management fee that's equal to 1% of the equity capital raised. And then we share in 20% of the profits, assuming that we pay the full preferred return. So it's kind of a hedge fund model. So a 1 in 20 deal plus the acquisition fee. But we're not, we don't ding people for, refinancing fees and sales fees and overseeing work on the property. We don't load up our deals with all those fees. We want to keep it really simple and really clear and the same every time. So the only thing that will change in our deals is the preferred return might change given the economics of the deal and how much we can afford to pay. I mean, we still have to make some money ourselves. So we can't be as generous as we want to all the time. But the fee structure never changes. We just want that to be very transparent.
What about the income, the cash flow part of it? Do you have a fixed percentage that your firm will take aside from the investors?
Yeah, so the way that we've structured our deals so far has been that the investors get their preferred return, which is generally 8%. We then get to participate in the next 2%. And assuming that that's fully paid out, then everything else is split 80-20 to the investor. So it's designed to be an 80-20 deal.
Gotcha.
Yeah.
Okay. Now, tell us a little bit about what types of properties are you looking for? Are you doing value add deals? Are you, doing major construction? Are you looking for high-end properties? What's sort of your typical profile?
So we look for a very specific type of deal. We only invest in B and C deals, and we only invest in property that's already stabilized. So what we look for is property that's already cash flowing well that we can buy at a good valuation because the current owner is not maximizing the value of the property. So we're not taking on deals where there's a lot of construction involved or repositioning. We don't do distress. We look for deals that are going to be paying our investors cash from the very first quarter after we close on the deal, but where we can add value because we're bringing in professional management. We have economies of scale. We try to buy property that's near property we already own so that we can co-manage the properties and share expenses. And that way we bring the expenses down. Professional management tends to be more consistent about raising rent and growing revenue than mom and pop management does. So, if we're underwriting a deal based on mom and pop management numbers, we know we can push those a bit because of the nature of professional management.
And do you try to buy your deals under market, or is that not necessarily a major factor?
I mean, obviously we would love to buy deals for less than they're worth, but I think that is very difficult to do in practice. What we like to try to do is get them off market. And that way, at least we are avoiding a bidding war where we're overpaying for a property. We don't have any problem paying what a property is worth. We think that we can add value after we close the deal, and that's how we grow our profitability and grow the value of the asset. But we're not really engaged in a game of trying to steal a property from somebody for less than what it's worth. I don't think that there are a lot of owners out there who don't know what their property is worth, to be honest with you. So, and especially if they're dealing with brokers, it's very difficult to find property that's quote unquote undervalued. So you really have to look at how you are adding value to the property after you take it over. So that's what we do. But there are investors that we are working with, generally speaking, are wanting cash flow right away. So they're not concerned so much with making a big, quick bang on the deal as they are in investing money in something that's safe, that's going to pay them, a coupon for years to come. So we actually like to buy deals from the rehabbers, because if they're rehabbers that do a good job, because the rehabbers have a very different kind of objective than that a long-term buy and hold investor has. A rehabber is not necessarily going to push rents to the top of the market, because they're looking to fill that property up as fast as they can. So, if they take a property over that's 50% occupied and they're rehabbing it, and then they're trying to fill it so they can sell it, they're going to be giving discounts to the renters, right, that they bring in, because they've got to get as many in as possible. So they're almost by nature leaving some meat on the bone for the next buyer. If we know of rehabbers who do a really good job with the rehab and are good about checking the quality of the tenants that they put in, we're buy those deals all day long, because our objective is to hold the deal for 10 years. And we want a property that's going to be in good shape to hold for 10 years. So we're happy to buy deals from rehabbers. Their model is such that it enables them to make a good profit very quickly, but almost prevents them from charging every single dollar of rent to their tenants, because they're trying to put people in quickly. So they'll put them in, slightly under market, which means that we have room to raise rents once we take over and start renewing leases and renting the property ourselves. So I think it's a good kind of symbiotic relationship between a good rehabber and someone like us who has a long-term buy and hold strategy.
Yeah, I would think that your due diligence on that would be key in terms of checking the applications, what's their screening process for tenants and so forth, to make sure you've got people that really aren't just bodies.
Yeah, and I think it's actually doing your due diligence on the rehabber or the seller is becoming more and more important, because something that we ran into on a recent deal was that the credit files for the tenants were not in the lease files. And the reason for that was because the seller was concerned about privacy issues with the tenants and concerned about identity theft issues. So they don't want to have the tenant credit files in the lease files, where someone might just come along and take their social security information. So I think that as people are doing due diligence now, the reputation of the seller itself is going to become more and more important, because you have to know who you're dealing with, because you might not actually get to see the credit files of the tenants, in the lease files.
Gotcha. Yeah. Let me just look at this in sort of a broader spectrum. Do you do any investing in New York, or are you primarily out of state in terms of all your properties?
Yeah, so we only do stuff in the Southeast. We don't do anything in the city.
Okay. So like what cities?
So we've been focused very heavily on the upstate area of South Carolina, it's along the I-85 corridor between Atlanta and Charlotte.
Okay. That's primarily with the properties that you have. The 4 properties are in that same area?
Yep.
And how did you select that out of all the many places you could have chosen?
Yeah, so the way that I decided which markets I wanted to be involved in came from some number crunching and then just some practical considerations. So on the number crunching aspect, when I started the business, the 2010 census data had recently come out. So there's a lot of information available to crunch in terms of which metro areas were growing. And for me, that's the primary concern when I'm looking at an area. Is the population growing or not? Like, that's kind of like the baseline consideration. First, I sorted all of the data for the census. I sorted it by fastest growing to slowest growing. I eliminated anything that was growing slower than the country as a whole. Only wanted to be in higher growth areas. That by itself basically knocked out the entire Northeast, because the Northeast is growing, but it's growing far slower than the country as a whole, even though it's incredibly expensive. And those are two things that are kind of counterintuitive. But so that was one thing. The other thing was that it had to be relatively close to New York. So, my experience in traveling to Louisiana was that it really took a long time to get there from New York. I wanted someplace that would be much closer. If I had to get on a plane quickly and deal with an issue at a property, I could be there fast. So, basically anything west of the Mississippi was out for that reason. So those two considerations really pointed me in the southeastern direction. Other factors came into play, like I really liked Charleston. I had a lot of friends in Charleston. I was able to meet some really great real estate folks in Charleston through my personal connections to other friends. And through those connections, I was able to start doing deals down there. But the upstate region of South Carolina was definitely on that list when I sorted things as a high growth area. And I wanted some places a little bit under the radar too. I mean, everybody was piling into Texas. Florida always seems to get a lot of attention from real estate investors. And just by nature, every time I see a lot of people doing something, I just kind of naturally want to do the opposite. So, so both of those areas scared me. I wasn't seeing the same kind of attention directed at the Carolinas, and that made me feel good that it was, a good place to look.
Oh, that's great. You weren't nervous, just starting off, immediately with properties in other states. Did you have people in place in these areas, or did you have to build up teams that you felt comfortable with?
Yeah, I definitely had to build up a team. One of the real lucky breaks for me was that through some personal friends, I was able to meet a guy by the name of Tyler Flesh down in Charleston. And Tyler had just a tremendous amount of real estate experience, a tremendous amount of multifamily experience in particular, knew, all of the brokers in the area, and, had personally transacted in different jobs he'd had for working for acquisition funds, had done like, 12,000 apartments or something. So he just had, years and years of experience and connections. And so he really became my right-hand guy on the ground in the Carolinas. And then, I always knew that I was going to third-party manage the deals that I did. So I knew that I wasn't going to have to, be dealing with the day-to-day management of the companies from afar, of the properties from afar. But I needed to find a management company I could rely on to do that for me.
Are there people also on the ground that are looking for deals for you, or are you the primary person that's kind of scouting those things out?
Yeah, so we've built up at this point a good network of brokers. The nature of the business is after you've done a couple of deals, all the brokers get to know who you are, and they start calling you. So we're on the radar for every sizable broker down there. People are constantly bringing us deals, bringing us off-market stuff. So we're not really ever suffering for deal flow, but we don't have, say, people bird dogging deals for us. I've had some just kind of less than spectacular results with that kind of stuff, where I think a lot of people get into the really good bird doggers already work for somebody else. Mm-hmm. So if people start offering to bird dog for you, they're usually starting out, and they bring you a lot of stuff that is not really appropriate. So I find it easier to rely on brokers for deals than it is to kind of work with people who say, "Hey, I'm going to bring you a deal."
And are you finding your rehabbers through your brokers primarily, or other sources?
Yeah, they're professional rehabbers, fairly big companies. And they're always selling their deals through brokers. So they may go to the broker and say, as has happened in the past, we only want to deal with these 3 buyers, and they'll name us as one of the buyers that they want to deal with. That's how we've sourced deals.
Okay. Looking at your company, what year did you found your company?
So we started Two Bridges in 2013.
Okay. What are your long-term goals for Two Bridges?
The intermediate goal is to double the size of the portfolio in the next couple of years, if not sooner. And ultimately, we would like to raise a fund, start doing this on a bigger scale. We'll continue doing the syndication deals, though. We like doing those deals, like working with individual investors. So we'll continue doing that for the foreseeable future, but definitely the long-term plan is to raise a fund.
You're doing all syndications right now for your properties?
That's right.
Okay. So do you have SEC folks that you're working with on the legal side help you establish that fund? Are there a lot of requirements?
Yeah, well, absolutely. I mean, the syndications are really mini funds. And
yeah, that's true.
So anybody who's doing syndications really needs to have their securities law team in place. Otherwise, they're really courting danger if they're not doing it. And I know that there are a lot of people out there who are doing syndication deals, who don't even realize that they are involved in securities law at all. Mm-hmm. And if anybody is listening to this, I really, highly recommend that you talk to your lawyers about how to structure these deals properly so you don't get into trouble. There may be some registration requirements if you do a fund, depending on how the fund is structured. But in terms of the structure of the fund versus the structure of a deal, it's actually very similar. I don't really anticipate there being any huge different legal requirements for a fund structure as opposed to what we're already doing.
Would you consider crowdfunding or any other sources to raise those funds?
Yeah, absolutely. I would definitely look into it. Yeah.
Great. And you mentioned sort of the short-term goal. The longer-term goal would be, maybe looking 20 years down the road or 10 years down the road.
Well, hopefully even sooner than that. I mean, I can't really think 10 years down the road. That's way too long away. But hopefully 5 years from now, I would like to have this fund completely raised and implemented and be looking at Fund 2 or Fund 3 at that point.
Oh, great. The folks that are listening to this, not all of them are retired, but there are those that are looking ahead to retirement, and there are those that are in retirement. And in most cases, there's concerns about being able to have the funds necessary to be able to see their retirement through and not just survive, but, to thrive, to have a nice retirement years, to be able to do the things that they really want to do. And so you have some that will be very casual investors and others that want to actually set up businesses. And I just wanted to get your thoughts on, given that situation, what kind of advice would you have for somebody that's in the latter season of their life? Put yourself in that position. You thought you were retired, but now you're looking at, you've got to do something to generate cash flow. How would you approach that?
I guess it would depend on what kind of assets you have available to you and how able you are to lock those up for a long time. I would say if you're at that point where you're close to retirement or you're in retirement, you want to look at deals, whether it's through a syndication that you might get involved with somebody else or your own deals where you're minimizing the amount of risk that you're taking on and trying to maximize the cash flow. So I would really be looking at more cash flowing type deals. I'm always very, to be honest with you, Bill, like I run into a lot of people who want to invest in real estate and they kind of have a misunderstanding about, at least from my perspective, about how to do it. They tend to focus overly on appreciation and not enough on cash flow. To the extent where they're actually willing to lose money in the short run because they think they're going to make money on the appreciation in the long run. And I find that to be, even if you're not closing in on retirement or in retirement, to be a very risky proposition. Cash flowing deals are actually like your insurance that the deal is a good deal. If it's making money for you now,
right,
and you don't have to focus on the appreciation, then you've got a lot of downside protection. If you're in a retirement situation or pre-retirement situation, I think you have to be really concerned about impairing your principal because that's what's going to provide the basis for your income going forward. So you really don't want to be in a situation where you've got to pay out of pocket to finance a deal that you think is going to give you appreciation someday. Unless you have a really tight business plan about flipping it. I mean, if you're really good at flipping, that's a different story. But if you're not, if you're kind of a casual investor looking for a way to make some money, I would be a little bit wary about taking on a high risk, high reward deal, and be looking more at more conservative investments that are going to cash flow right away.
Yeah, and I think that's the focus with our audience. It really is cash flow. Cash flow is king here, and being able to generate an immediate cash flow, and if within that the deal's got potential for equity growth and so forth, and other things, that's great. I would say most folks are really focused on the cash flow aspect.
Yeah,
and I think one part that's also a decision factor in this is, where do I start? Some, will start with, single family homes or small multis, duplexes and quads and so forth. And then there's folks like you that went right into, larger multifamily. And I personally feel that you could do either, but I think that there's obviously some real key benefits in the multifamily side, the larger multifamily side, not having to deal with so many different properties.
Right.
For one, I also think that your bottom line is actually going to be stronger too, because you can grow a lot. Everything's exponential when you've got 100 units as opposed to 2 units. If you do improvements on a duplex, you're going to see some slight changes that can definitely affect the bottom line. But on a 100 unit, if you do things there, it just affects the cash flow significantly.
Yeah, I mean, you've got economies of scale with a larger property that you don't have with a smaller one. So it's going to just be less management intensive to make the same amount of money. You've got to have the capital to do it. That's a consideration. And you have to invest sort of where you are with the resources you have. But I think the advice to buy the biggest property you can is a good one, because you'll always be generating more. It'll be more efficient. It'll be more profitable than a smaller property. And the other thing too that people should keep in mind is you're going to have turnover, right? Mm-hmm. And you're going to have vacancy no matter what. If you've got a month of vacancy on a 2-unit deal, right, that's a huge part of your cash flow for the year, right? If you've got a couple of vacancies on a 100-unit deal, then it's just a much smaller piece of your cash flow. So your vacancy risk is just lower on a bigger deal than it is on a smaller deal. That's something to keep in mind. If you're in a position where you have the choice between doing a bigger deal and doing a smaller deal, it's better to do a bigger one.
Yeah, I totally agree with you, and I think that there's just a lot of reservation for folks just thinking, gee, I mean, I can understand a little house or a couple of units, but it just seems so ominous, 150 units or 200 units or something of that nature, and when in fact, so much of the processes are the same, and you got to do due diligence on the little ones like you do on the big ones, and it's just a little different. And then there's the question of funding it and so forth. But I agree with you. I think that there's definitely an advantage, especially when time is a factor. I think over time somebody could start off with single family, move into small multis, and go in the other. When they've got a 10, 20-year plan. But for people that are looking at getting the cash now, and I think that the larger multis make sense.
Yeah, there's also the issue of needing to sell the deal.
Yes.
So there's a lot of different things to think about here. Syndication could be great for you if you really don't want to be involved day to day. If your objective is really to produce cash flow for yourself, but you don't want to take on the responsibility of running the property, syndication could be great. But the problem with syndication is that your money's going to be locked up for a long time. If you need to get out, you may not be able to sell your interest in that deal. So owning it yourself has the advantage of being able, that you can choose when to sell it. Just one thing that people should keep in mind, with larger deals, you're talking about more debt, you're talking about lenders with different requirements. So it may not be as easy to sell those deals as you think. That's one advantage to smaller deals, is that you're going to be under less restrictions in terms of your loan agreements. with the bank. The bank may want to be setting up a situation because it's going to sell that loan to somebody else where there's a guaranteed stream of income for 5 years or 7 years or what have you. You may not be able to pay off the mortgage. You may have to sell it. The buyer may have to assume it. That may depress your sales price somewhat. So there's a lot of different things to think about. There's a lot of moving parts that you might not have with a smaller deal. But that being said, if you think that you're going to hold the deal for a long time, and God forbid, if you think this is going to be something that you're going to die while you own, and you're going to pass it to your kids, and you're not really worried about having to sell it, then the bigger the better.
Right. Do you have, in your sort of longer term thinking, you mentioned that you're looking at holding on to properties at least 10 years, but do you ever look at sort of the possibility of an exit strategy where you might do sort of a cash out refi, pay off your investors and then continue to hold the property? Is that something you've ever looked at?
Yeah, absolutely. I mean, that's one exit strategy, is to refi, pay the investors either in whole or in part, and then we collectively, the investor group has got an asset there's no more money at risk. They're just making pure profit. So that's certainly something that you want to look at. Me personally, when I think about what I want to do really long term, ultimately the dream is to be able to finance my own real estate holdings purely out of my own money and not to have to be reliant on other people's money. I think other people's money is great for growing a business, but at the end of the day, you really want to be in a position where you can control things on your own and you don't have to be responsible to other people, and you don't have to be sharing the profit with other people to be in a position where you can just finance the deals yourself. I think that's the ultimate goal, certainly for me and for a lot of the folks who are doing the similar things to me.
Mm-hmm. Yeah, same here. Well, John, I could talk to you probably for a couple hours, and I've already run way over what I told you this would be, so I apologize for that. But gosh, you've got some great information, and I think there's a lot of meat there that our listeners can grab onto. And I would like to move on to sort of our closing section here, wrap up session. I'll ask you just a series of real quick questions and give your answers back, and then we'll close out. I'll let people know how to reach you before we close out here. And first question, your favorite real estate book?
Favorite real estate book? I'm actually not a big consumer of real estate books, but I have to say that one book that I really thought was terrific and really helped clarify my thinking was it's the Wall Street Journal's Guide to Real Estate Investing.
Yes, I'm familiar with that. Yeah,
that's just a terrific, really simple, straightforward, no fluff book about how to invest in real estate and how to think about it properly. And it's very accessible, easy to read. I highly recommend that.
How about your favorite business book?
Favorite business book is, well, currently, it changes all the time. I'm a big fan of The War of Art.
Mm-hmm. Yes.
By Stephen Pressfield. I love that book. I've read it many times. I try to reread it every few months. Just helps me to stay focused and to keep on, fighting every day, even when I don't feel like it.
Most valuable website, not counting your own, that you might access?
For real estate. I think that Bigger Pockets is actually really terrific.
Yeah, I love Bigger Pockets.
There's a lot of good people on that website, and it is a very helpful community where people are really they're really looking to help you. There's a lot of folks on there who have a lot of knowledge who are willing to share it for free in those forums, and I think it's a great place to start. And they also have some good materials, for getting started for people who want to learn about the different real estate possibilities. They've got, free ebooks that you can download. And I think it's for people who, especially people who are just starting out, I think Bigger Pockets is a great place to learn and to network.
How about either internet resource or an app that you use in your investing that's of value to you? Now, maybe a more business application may not be specifically real estate.
Well, this is a funny one, but the app that I really, really like is called Antisocial. And
that's great. I've never heard of it.
Yeah, Antisocial allows you to block websites so that you can focus on work. It's
That's great.
You can choose how from 5 minutes to hours and hours, and you can list the websites that you want to block, and you just turn it on, and you can and suddenly Facebook is not available anymore, and it's really it's really good for getting stuff done.
That's great. I love it. Okay, final one, and this is not an easy question, but that's just part of what we do here. Okay, if you had $1,000, okay, and taking what you know from again real estate investing, what would you do with that $1,000 to launch your real estate investing endeavors?
If I had $1,000, I would go and research some of the crowdfunding sites, and I think that some of them will allow you to invest as little as that, and it's a good way to really start learning how these deals work. And as an investor, you get access to all of the documents, and you can really start to study in a way that you can't if you're not involved. And also, now you've got skin in the game, so it's going to suddenly be a different process for you looking at the deals as opposed to just kind of kicking tires on them. So that's where I would start if you wanted to limit your risk to $1,000. Go to one of those crowdfunders and see if you can find a deal that you like.
Great idea. Well, that's our wrap-up section. I would like just to provide information so our folks could know where to find out about you, how to reach you. I know you got a great blog on your website that I think is an excellent resource. How can people reach you?
Yeah, so there's a couple of places. I know they always tell you you're only supposed to give people one option, and they're more likely to go there, but I'm actually going to give you two. So I'm going to ignore that advice, and probably people will go to neither. But so if you want to read my blog, it's called The Mortar Real Estate Blog. The website is www.themortarblog.com, and that's mortar as in bricks and mortar. That's where I write about real estate and try to provide some advice for people, the how-to kind of thing. If you want to learn more about my company and what we do in terms of our investments, that's Two Bridges Management. The website for that is Two Bridges, spelled out TWOBRIDGES, and then MGMT for management.com. So twobridgesmanagement.com. And if you Google us, you'll find us, even if you can't remember the URL.
Great. Well, Jonathan, it has been such a blast, and we're not quite done yet. There is one thing we ask all our guests that come on here, and that is to give us your best old hound dog howl, just for our fellow old dogs out there. Gosh, before you do that, I want to thank you and encourage everybody to follow your blog and get out there and start using some of this great information you provided today.
Yeah, thank you so much. And I'd be happy to be back and continue the conversation anytime you want. So this has been great.
I'll take you up on that.
I love being on the show, yeah. So I'll do my best at a howl. You guys should all cover your ears.
Go ahead.
Ooh!
Wow. That sounded like a dog died in the middle of it there. But
my voice went out in the middle of that.
Sorry. Again, that's my fault for holding you on too long here. But we'll let you do one more try on that, even though that was a pretty good one.
I just take a drink of water before I do it. All right, I'll give it another shot. Ooh, same problem.
It's okay. Hey, there's going to be howls like that, right? Your dogs.
My voice is cracking like a 13-year-old boy.
Well, that was great. Thank you so much, Jonathan. I really appreciate it, and I am going to take you up on having you back, and definitely want to get an update down the road here how things are going with you too. So
absolutely, Bill. Thank you so much. I really enjoyed it.
Well, thank you, and have a great day.
Thank you.